So this strategy is already efficient. It is already consistent. It is already going to give you profit for a beginner, intermediate, advanced. This is already going to get you there. But now I'm about to give you a pro tip that's going to give you an even better setup, an even better entry. So check this out.
Have faith in your mind, have faith in your grind, invest in yourself, transform in your time. Have faith in your mind, have faith in your grind, invest in yourself, transform in your time. Trading get paid, trading get paid, trading get paid, trading get paid, trading get paid. Oh yeah, trading get paid.
What's going on, guys? Joe Genta here, and it's time to trade and get paid. It's been a little while, and I got some content for you. I'm about to show you some stuff that's going to take you to the next level. Now, you know, if you've been around my channel at all, you know it's education over entertainment. This ain't about entertaining folks. This ain't about giving you like all my life's, you know, everything I'm doing, showing you what I'm eating and all that stuff. You know, I'm trying to give you education. I'm trying to show you how to trade. And man, just the students are telling me that they're learning. They're telling me about how successful they are. I got folks quitting their jobs, becoming full-time traders. Folks passing their Forex funds challenge, you know what I'm saying? Becoming funded traders based off of what I'm teaching them. So in today's video, I'm gonna show you a simple, one of the most simple strategies you're ever gonna find. Is gonna help you to become profitable simply off of following this simple couple of steps, all right? Now, I'm not a big indicator trader, but I told you that I'm here to give you what you're looking for. Everybody don't gotta trade like me, all right? I'm gonna show you how to use just a couple of little indicators, simple indicators, and it's gonna take you to a very high percentage trading, and it's very easy to do. You don't have to have a lot of steps. So beginners, this is where you should be starting. Like, as far as, you should really be focused on price action. You guys know I'm big on price action, making sure you do your order of operations. If you don't know what that is, you need to go and become a student and check out my videos on order of operations, because those videos are taking people to the next level. But for a beginner who's just ready to come in here with a small account and start just following the charts, look, I got you. This one is going to help you. So let's jump right into these charts and see what I'm talking about. All right, so what we're going to do is we're going to have a couple of moving averages here. Now, one of the ones that people use often is a 50 moving average. All a moving average, let me just explain first off what a moving average is. A moving average is very simple. It's exactly what it sounds like. It's the average of price movement. So a 50 moving average takes the last 50 candles and the closing price of all 50 of them, adds them together, and then divides it by 50. So essentially it's giving you the average, or the medium, the mean of the 50 time periods closing price and whatever the current price is, which allows the end of the moving average to go up and down. So on this particular case, you see a 50 moving average, and it is showing you what the average price is of the last 50 candles. So for an example, if you look right here, the end of that candle right there, this right here, is showing you that the average price of the last 50 candles is 1.09144. That is the average current price of the last 50 time periods, all right? So with that being said, let's take a look at the next one. The next one is the 200 moving average. That's giving you a much longer piece of information. It's giving you 4 times as much information. So what it's saying is, for the longer time frame, for the longer period of time, this is the average price, okay? And we have to remember that price always wants to live around average. In any market, whether that's real estate, Forex, stocks, or anything else, when price gets too high, it prices the buyers out. So nobody wants to buy high, right? So when you see price go really high, price is typically going to come down a little bit to show you, to bring buyers back into the market. And when price gets too low, sellers don't want to sell real low. And that's where the buyers come in, because they say, wow, this is a great deal. I can get this for a very low price. So the price will generally come back up. And so anytime you see price extended too high or too low, expect that price is going to try its best to come back to the middle or come back to average. Okay, so that's a little, just a little extra piece right there. Now, with that being said, if we know that that's the case, then I want you to look here. For the 200, that's the average price. For the 50, that's the average price. So what that's telling me is that the more recent information is at a lower price than the overall trend. Okay? So in other words, what it's saying is that currently price is lower than the overall average. So if we are in a trend that is moving up, then right now we have just came into a pullback. You see this? And therefore price is lower than what it would normally be. So if price wants to be here, price wants to be at that area right here, okay? But it is currently sitting below that, all right? So now let's look at the next piece. All right, so step one to the strategy is this. Is the 50 moving average higher or lower than the 200? Anytime you see the 50 underneath the 200, or in other words, below the 200, then you can say that we are in a downtrend currently. Anytime we see price or the 50 moving average above the 200, then that means that price is in an uptrend. So you can see here, price, the 50 or the yellow line is above the black line, or the 50 is above the 200, and price is moving in an upward direction. You can see it's moving in an upward direction. Once price comes back down, and it kind of gives you a little fake out there. And now a little pro tip here, no strategy is 100%. So that's why we're gonna always come back to price structure. If there's no volume in the market, we shouldn't be trading anyway. That's another video, but check out my videos on volume. Now, when price is back above, we see price going up. Now we see price is the 50 moving average is below the 200, and price is moving down. And so what I'm saying is, this is not just in and of itself everything, but what it does tell us is that this is what we call the death cross. Anytime you see that the 50 moving average crosses the 200 to the downside, that right there, this little cross right here, let me grab that for you. This little cross right here, that's called the death cross. Anytime you see that, big markets, big traders, what they know is that typically we're going into a downtrend. And when you see it cross to the upside, the same thing, it's called the golden cross. So you have a golden cross that moves the market up, and a death cross that moves the market down, okay? Now, does the cross itself move the market? No, it's the movement of the market that causes the crossover. So, with that being said, step one, what we want to see here for step one is that price is above when the line is above, and that price is below when the line is below, okay? So if you have an example here where the price is below, or the line, the 50 moving average is below, but price is above, are we gonna take that buy? No, we're not gonna take that buy. Why? Because we know that price is gonna try to come back to that 50. But when we just move up slightly, and now we see price is above, and we get this golden cross. Remember we called that the golden cross? When we get that golden cross, when price moves above, now suddenly we can be looking for buy entries. We can look for a buy entry because what we're saying is that the average price of the most recent move is now going to be above the average price of the long-term trend. Okay? So when we see price move above and it has volume, not no dead market like I showed you before, not like this kind of stuff. We want to see a nice engulfing candle. We want to see some movement to the upside. We want to see like some actual strength, not just a fake out. All right? When we see that and we also see this crossover happen, what that's telling you is that it's time to start looking for a buy entry. So let's just say in this particular case that we were to take right at the cross right there. Okay, so it's this candle right here that we would have took a buy entry. How do we know where our stop loss is going to be? Right, we're on this candle right here. Very little trick right here. You take your candle. You see that it's 7.8 pips on the 30-minute chart. Take that and times it by 1.5, or if you really are a conservative trader, you can times it by 2. Okay, so let's just times it by 2. So you have basically 8 pips. We're gonna set a 16 pip stop loss in this particular case. So right here we have a 16 pip stop loss. That gives us a safety net. Really what's awesome is if you look at it, it just comes right back to the moving average. So really what it's saying is if price was to go double than what my entry candle is, I'd be sitting right back at my moving average. So my stop loss is set right here, and then I'm going to look left. I'm gonna find nice structure. So I can go back, I can look left, and I can get it right into the top of that structure, and boom, right there, top of the structure. Let me drop a line on it so you can see it real nice. There you go, there's your take profit. There's your, here's your entry right here. And here's your stop loss right here. So you can see that you are in a 2.88 risk to reward. This is wonderful. That in and of itself will tell you when price is in your favor, because if you're trading and you're risking more than your reward is, there's no point. But in this particular case, I'm risking less than almost 1 to 3. So my risk is 1 to almost 3 times the reward. That's amazing. So if you see a 2.8 risk reward, that's awesome. And as you can see, as soon as price came up, we got some volume and boom, it took it right up. And so within just 30 minutes, let me see, 30, 1 hour, 2 hours, 3 hours, in 3.5 hours of trading, that's not even a half a day's work for most of us, 8-hour day guys, right? In 3.5 hours of trading, we had a beautiful trade here, and we made 46 pips on this crossover. Now, how do we know that we can keep going or not? Well, number one, you see where price starts to gas out. Look at how little the candles become. When you start to see the candles like go against you, you got 3 candles against you. Even in this case, you start to seeing yellow candles against you. Just close the trade. But if you're still in and you start to see multiple yellow candles or multiple bearish candles, get out of the trade. And when you really see the candles start to get small like this, now you know that the market is dead. It's time to get out of the trade. So here we are, and this is a beautiful setup based on volume coming into the market and seeing a golden cross, okay? Really nice setup, all based on price action and then a confirmation with a golden cross. So you saw that we had a cross here, went to the upside, and then the market pushed down. Now what happens over here? Well, the market pushes back down, and now we get what we call a death cross. Now notice how we already have a lot of volume, and then we have a lesser volume, and then we see volume pick back up, okay? So the first thing we need to understand is that now we have confirmed direction. So we have a high, low, lower high, and now we're waiting for a lower low. So if you look at it from a replay perspective, you can look at it like this, for example, and you just watch what happens. You see that it pushes up, you get one push down, and there's your cross. So it's on this candle that we see the cross. Okay, there it is. This is your entry candle right here. Okay, so again, here we go. We're gonna drop an entry at the close of the candle, and what we're gonna do is we're gonna take that candle and we're gonna measure it. Okay, take that candle, you measure it, and you have 18 pips. So you're gonna have a 36 pip stop loss. In this particular case, you get a 36 pip stop loss, and look, you're right near the averages again. Here we go. So how do you know where to go? You simply look left. Where can I go down to here? You know, so let's drop a line on it. Let's drop a line right there at the bottom, and let's see what price does. Let's see if price goes down there. Now, here's the other thing. Look at this. You have structure in between. You don't always have to get every last pip out of the market. Be safe. All right, so for the death cross, here we go. We have a death cross here. We have price was moving down. Price was above, moving down. We got a little kind of some sideways stuff right here. You obviously don't want to be into anything that looks ugly like that. You don't really want to be in that. So then you get the crossover right here. Here's your death cross. But here's the problem. Death cross happens and price is above the moving average. So would we want to take a sell or a buy when the line is below, or do we want to take a sell when the price is above? No, because that's indecision. There's no volume in that. But then we come here and we get this volume. Now, once we see that volume come, which side is this cross on? Now we see where we get that entry, okay? So we get volume here. You can do a breakout trade at this point right here. You're gonna get a little bit of drawdown if you're a swing trader. If you're a scalper, you'd wanna wait for a retest, and it would be right here where you see the line pushing away from the 50. So now or from the 200. So now you have the 200 above, the 50 below, and volume right there. There's your volume right there above that. It's like an engulfing close below candle. So now you have this. So now you come here, you have price, you want to take your candle and times it by 2. Remember just what we did before. Okay, so in this particular case, you have a 6 pip candle and you want a 12 pip stop loss. Okay, so you got a 12 pip stop loss, gets you above there, and then you look left. Can we get down to here? Can we get down to that structure right there? Let's see if we can get there. And obviously you see price pushes over, you get the death cross, you wait for your consolidation to end. You have volume, retest, you can do breakout trade here, retest trade here, either one works. And now you have another opportunity. So you're only risking 12, you're looking to get about 48, so you're at about a 1 to 4 risk to reward. And beautiful, beautiful setup just based on market structure and using the moving averages to give you direction, okay? So there we go again, entry, stop loss, and take profit, just waiting on these moving averages to agree with price and then give you some direction as to which way to move in the market. Now, that strategy is already efficient, it's already consistent, it's already strong. Now let me give you a pro tip that's gonna make you, give you even better entry, exit. It's gonna give you better setups, all right? So check this out. You can add another moving average, which is a standard 9 moving average. Now I want you to see something. When price is below here, you see that the 50 is moving down. We're way, way below the 200. So are we gonna wait for price to come all the way back up here to get another trade? Are we gonna wait for price for 50 moving average to come back and cross? No. What we're gonna do is we're gonna wait for agreement in the market, okay? So you have this 9 moving average that crosses to the upside. Now, in this particular case, we shouldn't be taking buys. Why? Because the 50 and the 9 are below the 200. So we shouldn't even be looking at a buy at this point. We should only be looking for sells. Once you see that you have the 9 above the 50, you know that you have opposite direction movement. However, once volume pushes back in and then price crosses back over, now you can take, and now this should only be for scalps. You should not be taking swing trades here. But this gives you an opportunity for a nice scalp. So here you go. You can get in right here. You get a little bit of drawdown right there. It's only a few pips. Watch this. You only got a few pips of drawdown. About 8 pips. It's not that big of a deal. And at the end of the day, on a breakout, you got about 10 pips on a scalp. Really nice trade for a scalp. But if you're really smart, you wait for the retest and that rejection right there. And once you get that rejection, now you take the trade and you catch a 14 pip move with very, very little risk. You can do this over and over again. This big candle takes us all the way back up to the 200, but it rejects up top. So we wait, we wait, we wait. Price crosses over. Boom, there we go. Here's your crossover. Entry. Look at how beautiful this is, guys. Look at that. Look at how nice that is. Beautiful trade setup. All again. Here we go again. Volume. We get the crossover. Drops again. Now suddenly that pro tip is that you're following that 9 moving average and you're doing the same thing we were doing up here, but you're doing it on a smaller way using the 200 as a way to find direction and then using the 9 as the crossover for your entries in order to get those scalping moves. Here's another one. Boom. Here's the entry right here. You get a little bit of drawdown, which is typically going to happen on crossover strategies, and then the bottom falls out. I mean, and these are great trades. Why? Because look at this. Look at this. You get this right here. Here's your entry. Here's your stop. Look at this. Great risk to reward. Over and over again. Do we take this? No, because we're under the 200. We come back here, we get a cross. It crosses. We would enter right here. In this case, why would we not want to enter? All we need is price action to tell us what to do. Let me give you this little, watch this, look. See the crossover? Let me put the line on it so you see it. You see the crossover happen right there, okay? It happens right after this candle. So this candle would be your entry candle. Now, why would we not want to enter? Because look at those wicks on the downside. Why would I enter when I see that there's obvious rejection? I know that I'm about to come into all this kind of garbage. I don't want to take that trade, right? So what I want to do is I want to wait for volume. Here we go again. Now we get another cross. This time I have volume. This time I don't see rejections, I don't see big wicks that are telling me no. This time I have volume. So now, here I am, I enter the market. I got my stop sitting back here, and look at this. Beautiful, beautiful move. Again. This is the pro tip. Use that 9 moving average to give you precise entries using this strategy. So the 200, follow the 50, and then follow the 9. Make sure that price action is number 1. You can't just use moving averages on their own. What you have to do is make sure that price action, make sure there's volume, make sure that you don't have rejection candles, make sure that price is not saying the opposite of what the moving averages are saying. And when you do that, you keep your disciplines in order, you will have high percentage trading strategy just following these lines. All right, guys, so I hope that brought you a lot of value. I hope you see the value in understanding price action before indicators. And the order of operation stuff is really going to help you, so I definitely want you to check that out in my community. You just go to tradinggetpaid.com and you can go and access all those videos, and I can take you into deep trading. This is a very beginner, easy strategy. I'm going to take you into the depths of trading and trading get paid. All right, so but just follow the moving averages. When the 50 is above the the 200, don't take sells. When the 50 is below the 200, don't take buys. Keep yourself safe. The first way to make money is by not losing money. Then, pro tip, add the 9 moving average in there and use that in conjunction with the 50 being above or below the 200. So once you have the death cross or the golden cross, use the 9 to follow down or up in whatever direction and make sure volume is carrying the day. Don't enter when there's rejection wicks. Don't enter if the market is sideways. Only enter when you have volume candles such as engulfing or close below or pin bar entries. Only use volume entries to get into the market. And if you do that, you will keep yourself safe, you will keep yourself in profit, and you will have high percentage win rate in your Forex trading. If this video brought you value, guys, man, don't forget, hit that like button, comment on it, share it, subscribe to the channel if you haven't already, and I've got plenty more content coming. I'll see you in the next video.